Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by Eugene Philalithis, manager of the Fidelity Multi-Asset Income Fund. Hello, Eugene.
Hello, Emma.
So multi-asset income, which means you're looking for yield. You're looking for yield from both equity dividends and indeed bond coupons. And within the bond market, we are finally, after years of expecting there to be a shift, starting to see yields rise in expectation of the Fed raising rates next month.
That's right. I think the market has fully priced in a rate hike in December, and I think it would take quite a lot of bad news or quite a dramatic shift in direction of markets or something sort of untoward happening for them to actually change their mind and not go ahead with this rate hike. So in this environment where the market has priced the rate hike in, we are seeing bond yields start to rise in anticipation of that, but also in anticipation of a change maybe in policy in the US, given the result of the US election, expectations for more fiscal spending, more spending on infrastructure, which could also be inflationary in the long term. And bond yields, I think, are rising to reflect that as well.
And with bond yields having been so suppressed for such a long time, equities have been the sort of favourable asset class for income investors. However, with yields rising, does that affect your asset allocation as a multi-asset income manager?
Well, we've been cautious on the outlook for inflation for quite a while, and we've thought that bond yields in general have been very on the low side and maybe a bit expensive relative to to what we expect in terms of inflation or growth. So we have been quite cautiously positioned with a lower allocation to high quality fixed income and looking for more assets that are less sensitive to interest rate rises or have explicit inflation linkage built in, or equities where the dividend can also has a real element because it can grow as well over time. So that gives us some protection from what we saw as one of the key threats to financial markets, which was an underpricing of inflation.
And of course, the Fed is not the only issuer of interest rates. Of course, there are other central banks around the world who may not be following this path as yet. So we've got divergence in central bank policy for the first time in a very long time, haven't we?
Absolutely, and that has a big impact on both the currencies of those regions, but also the impact on the various asset classes. So we would see that treasuries, the US bond market, is probably most directly influenced by changes to the Federal Reserve or Donald Trump's policies. But in Europe, we expect the European Central Bank to maintain its easing bias and try to keep interest rates low and will not raise rates anytime soon. We also think the Bank of England is likely to maintain its easing bias in the face of uncertainty around the sort of exit scenario. And also, the triggering of Article 50 in 2017 and what that might bring for the outlook for the UK economy. So we think that the yields in the UK and Europe might not rise as much or might be contained. But against that, we're also looking at opportunities where we can take advantage of this, because where there are higher yields, that also means that we can generate more income for our investors. So we're looking at asset classes such as high yield, where in a positive economic environment, the corporate balance sheets should do well and should be able to support that. We like equities as an asset class for their income characteristics, but also looking more broadly at emerging markets where we're seeing high and attractive real yields in those asset classes, and also in some non-traditional areas such as corporate loans, where the income is actually floating rate. So as interest rates rise, the income from those asset classes will also rise, and that gives us both protection from rising interest rates, but also an attractive level of income to look forward to.
Eugene, thank you very much.
Thank you, Emma.
This is Emma Wall from Morningstar. Thank you for watching.